Funds don't try to guess the market, they design income. They don't believe in stories, they buy structure. Before, the question was, how fast will this grow? Now the question is, who pays the bills while it's growing? In 2026, funds don't pay for smart ideas, they pay for structures that survive when the ideas start struggling. Hi, this is Ivan Marchena, Chief Communication Officer at Tailends. And today we will talk about where funds invest in 2026 and how you can copy that with $500. Alright, let me start by saying one thing out loud. Funds. Somewhere far away, suites, commits, billions, the access normal people don't have. And you are sitting there with $500 thinking, cool story, nice to watch someone else's life. But here's the part nobody really tells you. Funds don't have magic, funds have logic. And that logic has nothing to do with how big the check is. Funds don't try to guess the market, they design income. They don't believe in stories, they buy structure. Who pays, what they pay for, how long they pay, and what happens if things don't go as planned. That's why in 2026, a lot of retail investors will still be chasing meme coins, while funds calmly increase exposure to things that make money even when the headlines are screaming disaster. Today, I want to do two things. First, I will show you where funds are actually looking in 2026, real directions where money becomes necessary for the system. And second, I will show you how that same logic can be copied even if you don't have a portfolio. Just one car payment, some savings, and a real intention to build capital. Not smart guy lectures, but very concrete. Let's go. First, something important. Funds are not one thing. Before we go any further, we need to clear up one word. Funds. Because this is where half the confusion comes from. When people say smart money, they imagine one brain, one strategy, one giant wallet. In reality, it's like saying cars. There are trucks, sport cars, bus, taxis, four wheels, very different jobs. Same with funds. You have pension funds and insurance companies. They are not trying to make 10 times their money. Their main goal is to not break. They need predictability and a long horizon. You have some money, they buy influence, resource, infrastructure, long-term trends. You have endowments, universities, large foundations. They need stable income to fund budgets year after year. Private equity. They buy businesses, fix them, sell them. In 2026, it's harder for them. Debt, it's expensive. Exits are toward. Private credit. This one of the biggest shift right now. Think of it as a fund acting like a bank. They lend money on terms with collateral with contracts, and hedge funds, that's a different game entirely. Volatility, arbitrage, derivatives, and they got their own role. They show where the market's tension are. Why am I explaining all of this? Because when you ask where the funds invest, the question is really simple. Which type of capital is winning right now? And where does it feel in control? And in 2026, one of the biggest winners is capital that buys income through contracts. What changed by 2026? Money became demanding. If I had to say it in one sentence, in 2026, money stopped funding dreams by default. And that's not because everything is bad, it's because the price of mistakes went up. When capital was cheap, making a mistake was cheap too. You miss your numbers, refinance. The model didn't work, raise another round. No revenue yet, valuation will save you. When money becomes expensive, refinancing stops being a rescue button. It turns into an exam. And this is what changed inside the head of big capital. Before, the question was, how fast will this grow? Now the question is, who pays the bills while it's growing? That's a fundamental shift, and it explains why a huge amount of capitals move into private markets, especially private credit. If you look at major outlooks for 2026, players like BlackRock openly point to grow in asset-based financing and high-grade private credit. McKinsey says the same thing in plain language. Rates are structurally higher, but capital is still being deployed, just much more selectively. To translate it into human language, money didn't disappear, it just stopped being soft. How an investment committee actually thinks in 2026? Let's be honest for a second. Imagine you are sitting on an investment committee in 2026. Your job is not to sound smart, your job is to not look stupid when things go wrong. And that changed everything. So the real question in 2026 sounds like this. First, where does the money actually come from? Not where does the growth story come from, but who is paying? Who brings cash into the system? Second, what happens if results don't match expectation? And it doesn't mean that everything crashes overnight. It might be a slower demand, more expensive money, liquidity drying up, regulation changing, supply chains breaking. That's what the work committee plans for. Third, what do we actually control? Control means collateral, contracts, priority in the payment structure, enforcement rights, tariff, infrastructure monopoly, off-take agreements, and finally, who do we get out? This is crucial. Funds don't believe in, well, we figure out later. Either the exit is clear from the day one or they don't enter at all. And here is the core idea. In 2026, funds don't pay for smart ideas, they pay for structures that survive when the ideas start struggling. Where the money actually goes in 2026? This is the most important part. Here I'll name specific directions where fund capital is active right now. And while you are listening, remember one rule. Funds don't choose what's popular, they choose what the system can live without. Private credit. Funds become banks. If I had to name one direction that best describes 2026, it would be private credit. Why? Because businesses still need money. Even when sentiment is bad, even when banks tighten rules, and when banks are limited by regulations, something simple happens. Private capital fills the gap. That's not my opinion, that's straight from private market research. Inside private credit, a few areas stand out. Asset-based finance. Loans backed by real assets, inventory, equipment, machinery, receivables, direct lending to mid-sized businesses. Companies too big for start-up capital, too small for bond markets. High-grade private credit. Lower risk, tighter convenience, more modest returns, but much more control. Why do funds love asset-based finance in 2026? Because it feels controlled. If the business fails, you still have the assets. That's not a trend, that's the logic of the cycle. Infrastructures, but not bridges and roads. Infrastructure sounds boring until you realize it's the center of modern capitalism. And in 2026, infrastructure is not just concrete. Electricity demands keep rising. Data, industry, charging, AI, and grids are not infinitive. Energy storage, a generation can be built. Balancing the system is the bottleneck. And bottlenecks get paid. Data centers now treat like utilities, less tech history, more like ports, warehouse, power stations. Water infrastructure, always underrated. Water is a basic resource. Treatment, recycling, management, all pay usage. Logistic hubs, ports, warehouse, cold storage, especially food and pharma, don't disappear in recessions. Funds like infrastructure for one simple reason. Money comes from usage. People and businesses use it, so they pay. Resources, not a bet on price, a bet on shortage. This is a subtle but important difference. Retail investors often treat commodities like gambling. Gold will go up, copper will go up, oil will go up. Funds don't think like that. They don't buy price bets. They buy rights to cash flow. Royalties and streaming deals in mining. You don't own the mine. You own a slice of production or revenue. Processing and infrastructures around resource. Often the boring middle makes more money than extraction. Critical minerals, copper, lithium, nickel, rare earths, but again through the value of change, not just a ticker. Funds are not arguing about futures price. They are betting that shortage will be structural and someone will pay to solve them. Defense and security, a non-onshore budget. People don't like talking about this. Capital doesn't care. In 2026, security is not just weapons, it's cybersecurity. Digital systems expand. Attacks get cheaper, damage gets bigger. Dual-use technologies, drones, sensors, communications. Analytics used in both civilian and defense contexts. Supply chain resilience, localization, stockpiles, contract logistics. Funds budget at this point. Budgets are the best answer to the question who will pay. Real estate, selective, not everything. Funds still invest in real estate, just not blindly. In 2026, they are cautious on classic office space, but they like areas with structural demand. Housing, especially where supply is tight, logistics and warehouse, data centers, real estates, cold storage, medical facilities, because demand there isn't optional. That's the pattern across everything we just discussed. Funds don't buy optimism, they buy necessity. Why funds aren't running away from public markets, but are changing how they use them? Here is an important part. You'll often hear, funds dump public markets and move private. That's not really true. Funds still use public markets, just differently. They use them as a liquidity layer so they can move fast, hedge and adjust position. A tactical tool to exploit mispricing, volatility, short-term distortion. Proxy exposure when private deals are unavailable, crowded or overheated. But the core of capital building is moving away from assets that only work when markets are in a good mood. That's why 2026 increasingly looks like this. Public markets are the loud stage where money is made fast and lost fast. Private markets are the workshop where income is actually built. Structure over assets, how funds really buy income. This is the mindset change most people miss. Retail investors pick assets. Funds pick the deal structures. The same business can be a bad stock investment and a great credit investment at the same time. Why? Because stocks depend on sentiment and growth. Credit depends on payment schedules and legal priority. Here are the structures funds favor in 2026. Senior secured loans, top of the stacks, collateral, legal rights. Revenue-based financing. You get a slice of revenue. Doesn't matter if people love the story, the business has to sell. Off-take contracts. This is powerful. You fund production and a buyer commits in advance to purchase the output. Asset-backed notes. Paper-backed by real stuff. Equipment, inventory, property. The big takeaways. Funds aren't buying price appreciations, they are buying the right to a cash flow. Why this feels inaccessible if you are not a fund? So you heard about infrastructure, commodities, private credit, and my thing. Cool. But I am not a fund. I can buy mine. I can lend to a factory. I can write a $5 million check. That's fair. But you miss one thing. You don't need to copy fund assets. You need to copy fund principles. Principles scale. Assets don't. A fund issues a large secured loan against equipment. You can participate in a small pooled loan with collateral and clear terms. A fund buys infrastructure through private deals. You can buy public proxies, grid operators, storage platforms, and logistics. Funds buy cash flow. You can buy cash flow too, once you stop chasing stories and start choosing structure. How to apply fund logic with $500? A simple framework. Now let's get practical. Here is the system that works at any portfolio size. Think in 4 layers. You can start with $500 or $50. What you should focus on is consistency. Layer 1. Protection. Liquidity buffer. Funds always keep part of their capital liquid. Not because they are scared, but because liquidity gives them 2 superpowers. Staying calm, buying when others are forced to sell. For you, this is simple. A liquidity buffer is money for life. Cash you can access quickly, without losses, if something goes wrong. Income drops, you get sick, you lose a client, an emergency expense hits. Usually this is 1 to 3 months of essential expenses. Housing, food, transport, bills. Important point. This is not an investment, it's insurance. That's why it shouldn't live on the exchange or in a token. When stress hits, markets can drop, withdrawals can slow, and you don't need hope. You need to pay rent. Without a buffer, every dump feels like a crisis. But with a buffer, you stay in control, and sometimes even buy into the deep. Layer 2. The base, contract-driven income. This is the hair fund logic. There is a term, there is a rate, there is an obligation to pay. For funds, this is private credit and asset-based financing. For individuals, it can be accessible fixed income instruments, structured products with clear terms, platform where returns come from real businesses under contract. You don't need the highest yield, you need clarity. Here is the Odul test. Explain in 2 sentences where the money comes from. If you can, it's not income, it's a gamble. Layer 3. Long-term growth. Big trends, but through the shovel sellers. Funds do like big trends, but smart funds don't buy the gold rush, they buy the companies selling the shovels. AI, energy, data infrastructure, yes. But not as, wow, this token chart looks great here. As power and grids, energy storage, data center infrastructure, suppliers serving real demand. The message from major outlooks is clear. The trend will exist. Not everyone will win. So in the growth layer, diversification matters more than convictions. Layer 4. Optionality. Small bets, bid at sight. This is where high-risk ideas belong. But the keyword is small. Funds almost never bet the whole portfolio on one idea. They build portfolios like this. Limited downside, meaningful upside. For you, this might be 5 to 10% of the portfolio. And only if layers 1 and 2 exist. Because without a foundation, optionality isn't a strategy, it's just gambling. 2 main filters funds use, and they will save you from junk. I will give you 2 filters, just 2. If you use only this, your investing already gets better. Filter 1. Who pays? Not why this will go up. Who actually pays? Does a customer pay? Does the government pay? Does a business pay under a contract? Or does no one pay? And you are just waiting for the price to go up. The closer you are to the idea that the market will reprice this, the closer you are to a story. But the stories don't pay bills. Filter 2. What holds the deal if everything stops? If growth stops, if high dies, if liquidity disappears, what's left? A contract? Collateral? Legal rights? Priority in payments? If the answer is people will believe again or the market will recover, that's not a structure. Where a private investor is actually stronger than a fund. Here is the part people don't expect. You think a fund is always stronger than you. But that's not true. Funds are limited. They have rules. They have risk policies. They need big deal size. Small stuff doesn't matter to them. You can enter small deals. Build a portfolio from many small pieces. Hold long terms. Invest where it's too small for a fund but perfect for you. So you don't need to beat funds. You just need to stop giving up on yourself. These mistakes will be everywhere. People will buy complex things because they think this way complex is smart. It doesn't. Complexity often hides the fact that there is no clear idea. People will buy a story just because they love it, but the story is marketing. The future is cash flow. People will ignore structure because it's boring. Then they will shock it when everything falls apart. People will hunt for the perfect entry. Funds don't look for entries, they look for conditions. Fund logic in simple human language. Let's end with this. A fund doesn't pretend to be a prophet. It acts like an engineer. It doesn't guess what will happen. It builds positions that work in different outcomes. And if you have $500, you can do the same. Not by copying assets, but by copying logic. Buy cash flow. Look at the structure. Know who pays. Build capital constantly. Now, tell me one thing in the comments. Right now, are you more into stories or more into structure? Like, subscribe, and if you want a follow-up where I break this into real portfolios for different goals, say the word. I will do the next one exactly for that. See you!